It's a new weekly outlook, and now we have everything that we have been talking about for the last 2 weeks starting to come together. All the gaps that are starting to be filled now, a lot more developments on a lot of the major headlines, everything from equities, commodities to currencies, and everything like that. So let's take a look at what has already been going on. How has this weekend developments been, and then also what are we expecting in the coming week as well. So let's go back first to the week of June 16th. That's when Kevin Warsh first held his first meeting as the Fed chair, and the Fed's own internal rate projections start to shift hawkish. 9 out of the 18 officials were projecting a hike this year. And we flagged at the time that this was a genuine regime change. So it's not noise, and that the real test would be rather the actual inflation data over the following weeks would actually validate that or actually undercut it. So then we take a look at the PCE data points that just came out last week. And we see that when you look at the actual data points from May, it was 0.2%, which was supposed to be the previous, and it got revised from that 0.2%. The forecast was 0.3%, so the market was already expecting that inflation is going to continue to increase or accelerate at about 0.1%. And then the day of the actual release, or the data release, we got the revised number that came out. So on the surface level, it looks like that it came out exactly as forecasted. There's no surprise or anything like that. But the core inflation, which is the number that the Fed weighs most heavily, came in about a touch hot here. So that's the second piece of confirming evidence in 2 weeks here. That first is the Fed's own projections, which moved hawkish, then the actual data that backed it up. And that's why two major banks, Bank of America and Deutsche Bank, are both expecting that we're going to get 3 rate hikes totaling about 75 basis points by the end of this year. So that now we're getting 2 big banks who have already reversed their forecast midweek. First, they were saying that we're going to end up holding on to these interest rates until the end of the year, but now obviously completely reversing that. So this was kind of the gap in the market that we were trading when it came to a lot of the indices and when it came to a lot of the currencies and commodities as well. And now, obviously, the market is starting to price that in as we're getting more data points. This is also why the dollar's move to a 1-year high last week isn't really just, this last past week's news, or it's nothing that's surprising either. So look at the daily time frame, zoom out. The last time we came back and tapped into these levels was in May 2025. It's just a continuation of a trade that's been building since June 16th here, which is now just crossing the stronger or more significant technical level because the fundamental case is now just starting to get even stronger. So the same logic applies to even gold, where gold started to break down below that 4,000 mark last week on Thursday and Wednesday as well. And then Friday, it caught a little bit of a bid just to push back up. We have been describing gold's decline as the real yield story tied directly to the Fed since the first hawkish dot plot that we got. So last week wasn't really a new gold story. It was just the same story reaching its next milestone. Thursday, we're going to get NFP this week. It is a shortened week. Let's pull that up. It is a shortened week because Friday is a holiday in the US, but Thursday we're supposed to get NFP and we're supposed to get more employment data point. So this is going to be another or third data point in this sequence. If it comes in strong, then that's 3 consecutive confirmations of the hawkish case under just 3 weeks, which is going to be your genuinely hard pattern to really argue against. If it disappoints, then that's going to be the first real crack since June 16th. And, it's going to be worth treating it as a meaningful shift, not just one data point here. Now, another thing to watch for is 2 weeks ago, we covered the US-Iran deal getting signed early ahead of schedule with real optimism that the Strait of Hormuz situation was going to start resolving, where we're going to see that Strait of Hormuz was going to open up and all that stuff. Now what we're getting is the week after that, the situation flared up again. The talks got called off. Iran announced a new closure of Hormuz. Accusations flew in both directions. And we specifically flagged at that time that despite all that noise, the oil tankers kept moving through the strait, essentially, unaffected. And that the gap between the story or the headlines that we're getting and the physical reality was the most useful signal available. This week, the same exact pattern is playing out for the third time. Trump accused Iran of a drone attack on a cargo ship, calling it a quote-unquote foolish violation of the ceasefire. Hezbollah's leader said Friday that they won't disarm and Israel must fully withdraw from Lebanon. And more heated language, more acquisitions, that's what we keep seeing, that oscillation pattern. And once again, oil just keeps flowing through the Strait of Hormuz. We also see that oil prices are continuing to drop back down. We saw that it's dropping below that $73 mark and coming back down closer to the 70. And at one point, we even dropped below the $70 mark here as well. So we're not seeing any spikes here, which means that the market is really not pricing in any sort of fear that, we're not going to get a peace deal or the conversations are not going to continue. And this movement that's happening below that $70 mark is not just a coincidence either. That's just a pattern that we've now confirmed 3 separate times across 3 separate weeks, that we're going to see a diplomatic step forward. Then we see some sort of flare up over the Lebanon situation specifically, but physical oil flow is barely affected in any of these situations. So the lesson continues to compound each time. And we see it again, that Lebanon is the actual unresolved issue underneath all of this here. And it keeps resurfacing, but it has not yet translated into a real supply disruption. So until that physical pattern breaks, our oil position is not really going to be any different. And we're going to continue to expect that oil is going to continue to drop here. Now, another thing also that I want to point out when it comes specifically to NASDAQ, or if you're looking at any sort of tech stocks, is that we have been tracking the mechanical allocations when it comes to SpaceX IPO weeks ago. Back then, we laid out what we call the allocation clock, right? The idea that SpaceX stock price is, in the near term, it would be driven less by the company's actual fundamentals and more by a calendar of forced index buying or index fund buying events like NASDAQ 100 inclusion around the 15-day trading day mark, eventual S&P 500 eligibility, and so on. We also explicitly said that understanding this distinction, the fundamental story versus the allocation mechanic story, was the key to not getting confused by SpaceX price action in either direction. So let's actually pull up that stock as well. So that massive push up that we saw, and then right after that, a reversal, now coming back closer to the actual IPO day opening price, and at one point just below that as well. This week, that thesis stopped being, a forecast, is now obviously becoming a reality. We're seeing that. SpaceX joined the Russell 1000 after Friday's close, and NASDAQ confirmed that the stock would join NASDAQ on July 7th. Exactly the kind of dated mechanical catalyst we said to watch for, right? And just as we discussed when this thesis was first built, that short sellers are reportedly staying cautious, specifically because they know that billions of dollars in forced buying is coming for the stock, very specifically, regardless of what they think about the company's fundamentals. So that's the allocation clock thesis playing out almost exactly as we had described it weeks ago, right? The mechanics are now arriving on schedule. This also connects back to the first point that we were talking about. SpaceX volatile post-IPO performance was directly cited as a reason that OpenAI is considering delaying their own IPO. So the allocation mechanic story that we've tracked for weeks is now also shaping a separate major capital markets decision, which then fed into Friday's broader tech sell-off that we saw when it came to NASDAQ as well, coming back and closing at a new low. So now we're starting to see how all these different components that we're looking at, separately are now influencing each other. So that's why it's so important to understand the details of exactly what's happening. Now, going back to the prior week, we'd already been discussing real tension around AI infrastructure valuations getting stretched. This week, Tuesday's sell-off was that tension finally breaking loose. It was triggered by South Korea's crash, but really reflecting crowded positioning that had been building for a while. We had already seen Bank of America's fund manager survey as well, saying that a majority of the fund managers, they don't have dry powder to deploy back into the markets. And they're well above the equity benchmark of investing than they really should be. So at that time, when we start to see the crowded positioning that's been building for a while, on Tuesday, the question was, Wednesday's micron earnings, would they be able to answer, is the underlying AI spending story real, or did the market just kind of get ahead of itself? And then we got the actual earnings that came out, and let's come back here, this one here. The earnings that came out, and one of the strongest earnings that we have seen in the entire earnings season so far. And so the results here answered that question, as clearly as, any earnings can potentially answer that, saying that the spending is real. the demand is real, and the management even extended their confidence in the market tightness out of to 2027. So that settled the debate. But Thursday and Friday, the story got even more complicated again. And Apple and Microsoft fell on the memory cost pressure. And then we saw that OpenAI IPO delay report as well. So the fundamental demand thread just got resolved this week. Yes, that it's real, the AI demand. While a separate thread is the market still willing to pay current prices for that story. They're still generally open here that the market's still trying to price in. So here's what's connecting all four of these and what does it actually tell us rather than treating them as four separate stories still. The Fed point and the dollar point are the same, right? Just measured in different instruments. The Iran point keeps producing noise without changing the underlying physical picture, and it's about 3 weeks running now. Then we have the SpaceX point, which has now graduated from just being a forecast and what we're expecting to actually playing out as a life mechanic, and it's actively bleeding into the broader tech sentiment through the OpenAI connection as well. And then the tech valuation thread just got a real clean answer on fundamentals this week, even while the sentiment question around it is still open. So now the next upcoming major data point is going to be NFP on Thursday, and it's going to be released a day earlier because of the holiday. But the consensus here, the previous one was sitting at 172. You can see how the forecast is a lot lower. That's your basis point. This is the market basically telling you that we know that the labor market is not as strong across all the different sectors. We have already looked at the details of this, how majority of the jobs are really opening up just in the AI sector very specifically. But you can see how there's a lot of different moving parts here, especially when it comes to AI. From the earnings side, from the overall IPOs that we're seeing, from NASDAQ also with a massive sell-off, and then now with the jobs report also with a massive cushion. So here, we're already tracking this, but this is going to be the next major data point that's going to confirm what the Fed is already expecting of whether we're going to continue to see those 3 rate hikes actually, as Bank of America and a lot of the other banks are now starting to, reverse back on their forecast, or are we actually going to end up seeing just only 2 and potentially 1 in October and another one in December? So if you're surprised by the dollar strength, just remember all the points that we just talked about. And if you're panicking over the Iran headlines, just start to notice the patterns repeating for the 3rd straight week, and you will start to understand the details. So the main thing here is continue looking at the main details, not just the headline data points that are coming out. Now, in terms of what are we going to be focusing on this week, NASDAQ is going to remain the highest priority, sitting at the intersection of 3 separate points that we just talked about: the Fed and the dollar story, the SpaceX allocation mechanics, and the unresolved AI valuation sentiment question. Now, looking at the weekly time frame, we're still sitting in this massive consolidation. So a lot of this movement, until we get actual headlines or data points or fundamental catalysts, is just going to be a zone-to-zone trade. So you're sitting at 30,400 resistance and a support down here at about 28,700. So unless we can get real cracks and real data points showing us cracks in the AI sentiment story, this pair is going to continue, or NASDAQ is going to continue holding on to this weekly support. But as soon as we get that, there's going to be a massive sell-off that's going to come back down into the 25,000 marks. Drop down to the daily time frame here, and again, you're just seeing a zone-to-zone movement here. Drop down to the 4-hour, look at your exact levels, and you can see that as price starts to approach the support areas, it starts to consolidate out. So if price remains below this 4-hour support, then we're going to look for those continued sells from the 29,000 level that's sitting at to around 28,700, and then potentially even come back down a little bit deeper just for those liquidity grabs. Again, if you want to confirm what level is a liquidity level, or if there's actually truly liquidity there, just look at the volume that tends to follow right after. So we got a massive push up, which was a direct move right into that weekly resistance. So 28,700, and then even potentially down into around 28,400 area, and then a potential bounce right back up as we're continuing to track what's happening with the AI story here. Then the next major thing that we're going to be looking at is going to be USD JPY and any JPY cross, actually, so even GBP JPY as well. So stay on high alert for this, because right now we're still seeing that the dollar is pushing higher, and that is directly increasing the intervention risk in a pair that's already sitting at a very sensitive zone here. zoom out, look at the monthly levels, and you can see that USD/JPY is sitting at its all-time high level at this point. And the last time we came back to tap into it was in July 2024. And then we got another intervention, which caused that sell-off to the downside. And then after that, we're just retracing right back up. And a lot of it is being driven simply by the dollar strength. So here we are at, let's just say 162. Drop down to the daily time frame. And we have the support on the daily time frame, and now you have locked in into that consolidation right here, which is 161.2. If price continues to drop below this, which means that we would need to see some sort of dollar weakness or the actual intervention, then you have a massive sell-off that you can take, coming back down into the next support to about 129 pips, and then continuation down to about 269, and then come all the way down for about 500 pips to the downside, which is not a crazy movement given if there is any sort of intervention that does actually end up happening, you're going to get that clean movement down anyways. But until then, this is just going to keep inching higher and higher, creating those new highs. And then even on the 4-hour time frame, you can see how price is holding onto a support down here. And it's just sitting into this consolidation. So just be very careful as you're watching any JPY pairs. Let's go ahead and analyze GBP JPY as well. And here, same thing on the weekly time frame, you're starting to see a bit of consolidation, where you have 214.8, and then you also have this weekly support area down here too, which is 210.8. Drop down to the daily time frame, and you start to see consolidation down here as well. So this is another pair that I'm simply watching, but as soon as it breaks out of these weekly and daily levels, there's a couple of hundred pips that you can catch easy here. So this entire zone here is about 158 pips that you can catch. Even if you're looking for, let's say, a day trade opportunity or a scalp, and price can break outside of the zone, which we'll create here in just a little bit, you're still catching about 100 pips to the upside as well. So this is your exact daily consolidation resistance and your exact consolidation sitting in the middle right there. Now, the next thing that we're going to be watching after that is going to be gold, Euro USD, and GBP USD. So let's just do GBP USD, Euro USD, and then go back to gold. So with GBP USD, you're still sitting, that price is sitting at a weekly support here. And a lot of this is just with the US dollar and the Fed story. And it will primarily move off of Thursday's job reports as well. So that's going to be another major data point that we're going to continue to watch for all of these pairs here. So you have your 1.1 or 1.315, which is your weekly support. Last week closed with no clear direction, closed like a doji, which tells me that there wasn't a lot of volume or there wasn't a clear direction. Drop down to the daily time frame, and on the daily I see a lot of consolidation here. So that tells me that even on the daily time frame we don't have any sort of direction here whatsoever. Drop down to the 4-hour time frame, and I see that after creating a lower low, price pulled back a little bit, but it's starting to hold on to a resistance here. So I'm still treating this pair as a potential swing trade. I want price to break either above or below these weekly levels. And then if it breaks below it, then the first area of target is coming down to this wick fill for about 138 pips. And then a continuation down into the next major support, which is about almost 400 pips, as you can see. If it breaks above the weekly resistance, then we're coming back into the next resistance up top for about 184 pips. And then a continuation back up for about 364. And then tapping into the all-time highs, or the highs here, actually, the weekly consolidation highs for about 400 pips. Euro USD had a bit of a cleaner move, but then it started to retrace right back into that weekly level too. So here, we're just holding on to, let's just create the bottom wick right here as our support. And on the weekly, you have the candle body open from last week. Drop down to the daily, and we see a bounce off of the support, pushing right back up, rejecting right into this previous support area here, so you can create a zone, and drop down to lower time frames and start analyzing what actually happened here. So drop down to the 4-hour, and you see a hard sell-off, and price is continuing its bearish structure here. Again, driven mainly by the US dollar strength here. Same exact thing as GBP USD. I'm treating this pair as a swing trade opportunity as well. So if price can continue breaking its own low and we continue to push back down, get some candle closures, we're coming back down for about 200 pips to the downside. If it breaks its own high and then pushes right back up bullish, then we have about 145 pips to the upside. But it's very important that you identify that right now we're in a bearish structure, mainly driven by the US dollar strength here. And so if price breaks above this, then that means that we need more relief when it comes to the US dollar. Then let's take a look at gold. So gold, you can see how it's starting. It's a bearish retracement down here, that corrective move. It tapped into a strong weekly support to the left, bounced off of that pretty hard, 3964.4, and then dropped down to the daily time frame. And you have this resistance, the previous daily candle's resistance right here, at that 4107.35 area. If price continues to break above that, then you have those clean moves to come back up bullish, to tap back up into these previous daily resistance areas. And then after that, the next resistance is up top there, so on and so forth. But right now on the daily time frame, you're clearly in a bearish structure. You're tapping into a very strong weekly support level as well. So just be a little bit more patient. There's a very high probability that price doesn't even get to go all the way up top there. If anything, it'll probably just create another lower high formation, come back down, continue to push back below this area, and that's your sell. So that's your target only if this weekly and the daily resistance here could be broken and then continues back up bullish. But as of right now, it just seems like price is creating those lower lows and lower highs. And then the next thing here is going to be oil, and then we'll come back to US 30 because that's going to be my favorite pair for this week. With oil, you can see that as soon as we start talking about that peace deal and the actual physical oil is not being affected, the flow of that oil is not being affected, US oil continues to drop regardless of whatever's happening on the headlines, right? So that's the main thing. Continue to watch the tankers flow, and if it's not being affected, oil is going to continue to drop back down into its average areas, which is below that $70 mark, coming back down potentially even into the 55 if there's no effect whatsoever when it comes to the actual oil flows. So that is your 68.65 on the weekly time frame, that bottom wick rejection. Drop down to the daily, look to the left, you have your previous resistance areas. So you can see that for the most part, price is just kind of hanging around here. That is your 76.85. And so before price pushes all the way up top there, it needs to break a current level, which is this current resistance here. If it breaks above that, then you got your clean trades above that $72 mark into that 76.85. If price breaks its own low down here and it pushes back down, then ultimately we are targeting back into these support areas right here, which is going to be around the $61, $62 mark here. Drop down to the 4-hour time frame and you see how price is kind of just hanging around here. So there's a lot of consolidation at major support levels when it comes to oil specifically. And then as we get more data points, you're going to continue to see that oil is going to continue to drop as well. But here, mainly, you don't need to watch, NFP as closely or any other US data points like that. The main thing for US oil for this week is going to be the actual flow data points, not the headlines, exactly as the patterns from the past 3 weeks continue to form and continue to tell us that oil does not care. US oil does not care about any other data points. It doesn't care about those fresh launches or whatever that are happening. It only cares about the actual flow of the oil. So continue watching that. And then the next thing for us is going to be US 30. So this is what is going to be my favorite pair because it's benefiting from the rotation away from the tensions and with NASDAQ, with the tech sell-off, with SpaceX and all that stuff, because you're starting to see that a lot more investors and traders are starting to rotate out of the rate sensitive and that AI exposed stocks into more of like cyclical or more than financial healthcare or those type of like safer assets instead. And US 30 provides that safety for investors. So now we tapped into those new all-time highs already last week, which is so different from NASDAQ and S&P 500, where US 30 is now creating those all-time highs as well. So that was the 72 or 52,700. So take a look at S&P 500 too, right, where it's pushing back down bearish, NASDAQ pushing back down bearish, US 30 being the opposite. So that tells you where the capital is rotating. And then we also still have the gap that we haven't completely filled from about 2 weeks ago. So that is your 51,400. Drop down to the daily time frame. And we are still, after creating a massive top wick, pulls right back down. And we have this daily resistance right here. So even on the daily time frame, there's still a lot of consolidation, and that is the market preparing, pre-positioning ahead of a lot of the red folders and the headlines, and just preparing itself for a lot of the other data points, earnings, and all that type of stuff that's coming out from the market. So that happens from a fundamental perspective. When you come down to the 4-hour time frame, your exact consolidation here is right here. If price continues to drop below that, then you're looking for about 51, let's just say 700 down into 51,400. So you have about a 300-point move to the downside, or you have a 700-point move to the upside if price comes back, breaks above this, and comes into filling that wick to the upside. So these are some of our major pairs that we're watching this week. If you have any questions, again, feel free to reach out on Instagram at ShermaFX. But that's the week ahead, and properly connected to where we have been, the type of analysis that we have been looking at, the gap between the headlines and the data points that we saw versus what the market was already pricing in, and now the market's actually pricing this in. So the next checkpoint on the Fed point here is going to be Thursday's job report. So watch the oil flow data points, not just the headlines on the geopolitical side, and then also watch how SpaceX mechanical buying interacts with the broader tech sentiment as two generally separate forces. So make sure that you're still following your discipline, your risk management, and I'll see you guys for the Wednesday live session.